Well, good morning and welcome. My name is Greg Maggs. I'm the interim dean of the George Washington University Law School, and on behalf of the entire law school faculty, staff, and students, I'd like to welcome you to this event. I'd like to especially greet our distinguished speakers, Senator Warren and everyone else who will be introduced to you shortly. I would also like to thank those in attendance for coming. This is an important event, and we're glad to share the wisdom of our speakers with you. I've been asked to be very brief because the Senator is on a very tight time schedule today, so I just want to give a few thanks. I want to thank the Law School Center for Law, Economics, and Finance and its Executive Director, Art Wilmarth, and also Better Markets, our co-sponsor of this event, and Dennis Kelleher, the president of Better Markets, for putting together this extraordinary event. I want to thank the Marvin Center staff for organizing the physical facility here, and then also the student members of our Banking and Securities Law Society and our Corporate and Business Law Society put in a lot of hours in organizing all this. Let me now introduce Professor Art Wilmarth, who is the Executive Director of the Center for Law, Economics, and Finance, to say a few more words of introduction. Thank you.
Thank you very much, Dean Maggs, and welcome everyone. We're delighted you could join us for this important event. I think as all of you probably know, and certainly as you're here today, we are commemorating a very important anniversary in this nation's financial and economic history, and I think today Senator Warren and our distinguished panel of speakers will help us to reflect on the lessons of that collapse and crisis and what we may have learned from it, perhaps what we may still need to learn from it. I would like to again convey my thanks to all the people mentioned by Dean Maggs. This event would not have been possible without our wonderful staff at the Marvin Center and the Law School, our wonderful students, and many others who've contributed. I particularly want to thank Dennis Kelleher, the president and CEO of Better Markets. As you probably know, Better Markets is one of the leading advocates of financial reform in Washington, D.C., and indeed the nation. And it was really Dennis who conceived of this program and really helped me to organize it, and certainly did an incredible job in recruiting the very impressive lineup of speakers we have today. Dennis himself has a very distinguished career, including being a graduate of the Harvard Law School, a veteran, having served 4 years in the Air Force, served in a number of capacities in the United States Senate, including as Chief Counsel and Senate Leadership Advisor to the Chairman of the Senate Democratic Policy Committee. He was also litigation partner for a number of years at Skadden Arps and dealt with a lot of securities and financial matters during that time. So Dennis has seen these issues from both the private and public sectors. I would like to introduce Dennis now and bring him to the podium so that he can introduce our keynote speaker. Thank you.
Welcome, everybody. Thank you, Art. I said for the bio, he should just say he's been around a long time and he's kind of old, but he went on longer than that. Thank you all for coming. Thank you to GW Law and the Sealeaf program. It's a great school, a great program, great people, and you're a great partner. You couldn't partner with anybody better than that. We're very fortunate to have Senator Elizabeth Warren here today. Her full bio's in the program, and most of you already know it well, and I'm not going to repeat that. I've been fortunate to know Senator Warren for many years as an accomplished professor at Harvard Law School, where she was a bankruptcy expert, among other things, long before she led the fight to create the Consumer Financial Protection Bureau, long before she led the TARP Congressional Oversight Panel. And I want to say what people see here today, now that she's a public official, an intelligent, thoughtful, articulate advocate, driven by principle, common sense, and genuine compassion, have always been there for decades. What you're seeing now, we've known for a long, long time in Elizabeth Warren. She speaks truth to power, asks the hard questions, tackles the toughest issues. She's fearless, relentless, and courageous. And nothing shows the world that more than her fight, a relentless fight, for a safer, sounder financial system that serves Main Street in our economy rather than the few and the wealthy. When I think of Elizabeth Warren, I think of one of my favorite quotes from Senator Robert Kennedy. Quote, "Few people are willing to brave the disapproval of their fellows, the censure of their colleagues, the wrath of their society. Moral courage is a rarer commodity than bravery in battle or great intelligence. Yet it is the one essential, vital quality for those who seek to change a world which yields most painfully to change, close quote. We're in historic times, and we have been for 5 years now. The standard of living and the well-being of virtually every American has been on the line for over 5 years now. And it continues with the policies you see today. The point of this today is to remember what happened before, where we are, and where we're going. With that, I'd like to introduce a courageous change agent, Senator Elizabeth Warren.
Oh, thank you. Thank you. That's a very generous introduction, and I very much appreciate it. I want to thank Dennis and Art for inviting me here today, George Washington University Law School for doing this, and to Better Markets for helping put this together. I also want to say, you know, it's perfunctory to say, gee, wish I could stay all day, but with a panel like the panel you've got coming up, that's really where I want to be, is in the middle of the conversation about what's happened over the last 5 years and where we're headed over the next 5 years. We all know it's been 5 years since the financial crisis, and most of us remember its darkest days when credit dried up, the stock market cratered, historic institutions like Lehman Brothers and Merrill Lynch were wiped out. There were legitimate fears that the dominoes of our financial system would never stop falling, and that we were headed into another Great Depression. Now, we averted that grim outcome, but the damage was staggering. You'll probably hear more about it as we go through the day. But a recent report by the Federal Reserve of Dallas estimated that the financial cost of the crisis was $14 trillion. That's trillion with a T. That's $120,000 for every household in America, more than 2 years worth of earnings for the average family. Just disappeared. Billions of dollars in retirement savings disappeared. Millions of workers lost their jobs and their sense of financial security. Entire communities were devastated. A Census Bureau study that just came out last week showed that young families with children now have a 15% lower home ownership rate than they had before the crisis. The crash of 2008 changed lives forever around this country. Now, in April of 2011, after a 2-year bipartisan inquiry, the Senate Permanent Committee on Investigations released a 635-page report that identified the primary factors that led to the crisis. So here's how they put it. They said the list included high-risk mortgage lending, inaccurate credit ratings, exotic financial products, and, to top it all off, the repeated failure of regulators to stop the madness. Senator Tom Coburn, who's the subcommittee's ranking member, described it this way. He said, blame for the mess lies everywhere, from federal regulators who cast a blind eye, Wall Street bankers who let greed run wild, and members of Congress who failed to provide oversight. Even Jamie Dimon, the CEO of J.P. Morgan Chase, has emphasized inadequate regulation as a source of the crisis. He wrote this to his shareholders. Had there been stronger standards in the mortgage market, one huge cause of the recent crisis might have been avoided. So think about that. The crash happened quickly and dramatically. It caught our nation unawares and evidently caught our regulators unawares. But don't let that fool you. The causes of the crisis were years in the making, and the warning signs were everywhere. Now, as some of you may know, I spent most of my career studying the growing economic pressures on middle-class families, families that worked hard, played by the rules, but still can't get ahead. And I've also studied how the financial services industry developed over time. You know, a generation ago, the price of financial services, credit cards, checking accounts, mortgages, signature loans, it was all pretty easy to see. Both the borrowers and the lenders understood the basic terms of the deal. But by the time the financial crisis hit, a very different form of pricing had emerged. Lenders had begun to use a low advertised price on the front end to entice customers to come in, and then they made their real money on the fees and the charges and the penalties and the repricing that were in the back end on the fine print that no one saw. Buyers became less and less able to evaluate the risks of a financial product. Comparison shopping became almost impossible, and the market became less efficient. Credit card companies took the lead. I always love to look at this. What happened to their contracts? Basic credit card contract in 1980 was about a page and a half long. By the early 2000s, that credit card contract was more than 30 pages long. And believe me, the 30 pages was not there to help the consumer. The teaser rate credit card, that is the one that advertised the low upfront price and then the real price was somewhere, came along later, paved the way for the teaser rate mortgage that we started seeing in the 2000s. When I worked to set up the Consumer Financial Protection Bureau, I pushed hard for steps that would increase transparency in the marketplace. The way I saw it, this crisis began one lousy mortgage at a time. And we needed a cop on the beat to make sure that we wouldn't have those lousy mortgages. I think there never will be so many lousy mortgages again now that we've got the consumer agency. I think we're a lot safer than we are on that front. But there are a whole lot of other causes to this crisis. And there's no question that Dodd-Frank was a strong bill, strongest in 3 generations. I didn't have a chance to vote for it because I wasn't yet in the Senate. But if I had been, I probably would have voted for it twice. Glad to see the regulation, but it is not perfect. And so there's an important question to ask. Where are we now, 5 years after the crisis hit and 3 years after Dodd-Frank? So there are a lot of issues to discuss, and we have lots of great people here who will discuss them. I'm sure there'll be lots of pieces they pull apart. But I want to focus on one piece, and that's the part about too big to fail. Where are we on making sure that the behemoth institutions on Wall Street can't bring down the economy with a wild gamble? Where are we on ending the system that led investors and CEOs to scoop up all the profits in good times and then push the losses off to the taxpayers in bad times? Well, after the crisis, there was a lot of discussion about how too big to fail distorted the marketplace, created lower borrowing costs for the largest institutions, and created competitive disadvantages for the smaller institutions. There was talk about moral hazard and about the dangers of big banks getting a free, unwritten, government-guaranteed insurance policy. Sure, there was talk, but look at what happened. Today, the 4 largest banks are 30% larger than they were 5 years ago. The 5 largest banks now hold more than half of all the banking assets in the United States. One study earlier this year showed that the too big to fail status, giving the 10 biggest U.S. banks an annual subsidy of $83 billion. Wow. Who would have thought 5 years ago, after we witnessed firsthand the dangers of an overly concentrated financial system, that the too big to fail problem would only have gotten worse? Now, there are a lot of people who say, sure, too big to fail isn't over yet, but Congress should wait to act until the agencies finish issuing the Dodd-Frank rules. After all, a bunch of those rules haven't yet been issued. And it's true. There are a lot of rules that are still to be written, but that's because the agencies have missed more than 60% of their deadlines in writing the rules under Dodd-Frank. So I'm having trouble understanding the logic here. Since when does Congress set deadlines, watch regulators miss most of them, and then take that failure to meet the deadlines as a reason for Congress not to act? I thought that if the regulators failed, it was time for Congress to step in. That's what oversight means. And it's certainly a principle that would have served our country well prior to the last crisis. So let's put the pieces together. It's been 3 years since Dodd-Frank was passed. The biggest banks are bigger than ever. The risk to the system has grown, and the market distortions have continued. Now, while the CFPB has met every statutory deadline, so we know it's possible to meet the statutory deadlines, the other regulators have missed their deadlines and haven't given us much reason for confidence. The result is that the too big to fail problem remains. I add that up, and it's clear to me it's time to act. The last thing we should do is wait for more crises, for another London whale, before we take action. For that reason, I partnered with Senators John McCain, Maria Cantwell, and Angus King to offer up a way to address the too big to fail problem, a 21st Century Glass-Steagall Act. Now, by separating traditional depository banks from riskier financial institutions, the 1933 Glass-Steagall Act laid the groundwork for half a century of financial stability. During that time, we built a robust and thriving middle class. But throughout the 1980s and 1990s, Congress and regulators chipped away at Glass-Steagall's protections, encouraging the growth of megabanks and a sharp increase in systemic risk. They finally finished the task in 1999 with the passage of Gramm-Leach-Bliley, which eliminated the Glass-Steagall protections altogether. The 21st Century Glass-Steagall Act would reinstate many of the protections of the original Glass-Steagall Act. It would wall off depository institutions from riskier activities like investment banking, swaps dealing, private equity activities. It would encourage financial institutions to shrink, eliminate their ability to rely on federal depository insurance as a backstop for their high-risk activities. In other words, the 21st Century Glass-Steagall Act would attack both the too big and too fail. It would reduce the failures of big banks by making banking boring, by protecting deposits, providing stability to the system even in bad times. And it would reduce the too big part by dismantling the behemoths so that big banks would still be big, but not too big to fail, or for that matter, too big to manage, too big to regulate, too big for trial, or too big for jail. That's the idea. Big banks would once again have an understandable balance sheet, and with that would come greater market discipline. Now, sure, the lobbyists for Wall Street will say that if we do this, the sky will fall if they can't use access to checking accounts and savings accounts to fund their high-risk activities. They said that in the 1930s too, but they were wrong then and they are wrong now. The Glass-Steagall Act would restore stability to the financial system, stability that began to disappear in the 1980s and 1990s. Now, look, this is one way to deal with the too big to fail, and I think it would work, but there are other approaches too. What I want to know is how much longer should Congress wait for regulators to fix this problem? Do we wait another 3 months, another 3 years, until the next big bank comes crashing down and threatens the entire economy? Well, Secretary of the Treasury Jack Lew said recently that if too big to fail is still a problem at the end of the year, it might be time to consider other options. I applaud Secretary Lew for laying out a timeline, and I'd like to see other administration officials and regulators follow suit. If Dodd-Frank gives the regulators the tools to end too big to fail, that's great. Pick them up and use them. But if the regulators won't end too big to fail, then Congress must act to protect our economy and prevent future crises. We should not accept a financial system that allows the biggest banks to emerge from a crisis in record-setting shape, while ordinary Americans continue to struggle. And we should not accept a regulatory system that is so besieged by lobbyists for the big banks that it takes years to deliver rules, and then the rules that are delivered are often watered down and ineffective. What we need is a system that puts an end to the boom and bust, a system that recognizes we don't grow this country from the financial sector, we grow this country from the middle class. Powerful interests will fight to hang on to every benefit they now enjoy. Even after exploiting consumers, larding their books with excessive risks, and making bad bets that brought down the economy and forced taxpayer bailouts, the big Wall Street banks are not chastened. They have fought to delay and hamstring the implementation of financial reform, and they will continue to fight every inch of the way. That's the battlefield. That's what we're up against. But David beat Goliath with the establishment of the Consumer Financial Protection Bureau, and again, by getting Rich Cordray confirmed as the director of that agency. David beat Goliath with the passage of Dodd-Frank. I am confident David can beat Goliath on Too Big to Fail. We just have to pick up our slingshots again. So it's good to see you all. Thank you. Thank you. Thank you. Thank you. Thank you. Thank you. Thank you.
Thank you, Senator.